This is Rob Barnett from Bloomberg Intelligence, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and recent themes and catalysts related to energy markets. Today we are joined by a very special guest, our colleague Colin McKerracher from BloombergNEF. If you don't know Colin, he's the head of everything related to electric vehicles that BloombergNEF is doing, and I know we have an oil weighting on this call, so you may not like what everything Colin has to say about some of the transformations he's seeing in the space. So I'd encourage you to listen and think about the world as he sees it. So Colin, you have recently put out what you guys call EVO, I believe, Electric Vehicle Outlook. I think you've got some pretty stunning expectations for growth in the plug-in vehicle market. So why don't you tell us how quickly EVs are growing and what the read across for oil demand might be?
Yeah, just so at a high level, when we do this exercise, it's important to note that it's an outlook for all of road transport. So when we started doing it, it was really about EVs, and that's still the biggest headline thing because that's the biggest thing changing road transport right now. But it's about everything that happens around how people and goods move in road transport. So that's the kind of the starting point is trillions of kilometers traveled by people and billions of freight ton miles moved around the world each year. So just before I get to the EV adoption part of it, one of the important things when we talk about oil demand is actually what do you think happens to overall growth in demand for mobility and freight? Because in some ways, your scenarios that some people have on EV adoption might be fully outweighed by just overall fleet growth. The difference in, say, a certain penetration rate of EVs might be totally overwhelmed by just overall fleet growth. So the starting point is just to say that we probably have a more pessimistic view on overall size of the passenger vehicle fleet growth than some of the oil majors do, certainly. So generally, when we're out in around 2040 in the outlook, we're more like around 1.6 billion cars on the road versus some of the oil majors, you'd see that usually more like 2 billion cars on the road. And the reason for that, so again, that's 400 million cars that we're talking about. Just for reference, is about 20 million EVs on the road today. So that obviously makes a big difference in terms of the starting point. The reason for that divergence is really because, in my view, we've done a really deep dive on some of the things that we think would change the trajectory that we're on today. If you just looked at population and just looked at GDP, you'd probably get to something closer to what most of the oil majors have. We've done a few things. One of them is to look more at detailed at the demographic trends around urbanization. One of the few trends we have over thousands of years of human civilization is that more and more people live in cities every year. And as people get wealthier and live in cities, they are more and more concerned about emissions and local air quality. So not even talking about CO2, just particulates, NOx emissions, more people in cities. Where are you physically going to put all those cars? It's hard to see a city today that you think, wow, in 2040 it'd be great if there was twice as many cars as there are today. So that's one thing. Another one is around working age populations and starting to see a peak there. Certainly places like China, the working age population has already peaked, which is also the car buying population generally. And then the last one is shared mobility. So again, this is all before we get into the EV adoption curve, but we do see a growing role for shared mobility. So more and more kilometers or miles shifting over to shared platforms. It's still relatively modest. I mean, most people in our view are still going to go in a privately owned passenger car most places most of the time. But it does play a growing role. So in our outlook, it goes from sort of around 3% of all miles traveled in the world today being in some sort of shared mobility platform, and that includes regular taxis as well as Ubers and car sharing and ride hailing, all those things together, to more like 15%. Now, if you have a more aggressive view on autonomous vehicles, which we're a bit pessimistic on, you might say, we don't see them playing a big role until around 2035, then you might see that go faster or slower. But we don't factor in a really big impact from that, at least in the time frame out to 2040. But so all that is just to sort of say that the starting point really matters. And in general, we see less cars overall on the road than some of the groups doing some of the forecasting. So within that,
so what's the takeaway on, given all of the caveats, what are some of the bright lines on kind of when you see gasoline and diesel demand kind of hitting their peak levels?
Yeah, so this is one of the, I think, interesting findings in this year's outlook is that actually in terms of, to get to diesel, we need to start with fleet and to get to of cars and efficiency of those cars, and to get to that we need to also look at sales. And one of the interesting things is that sales, it looks like sales of gasoline and diesel vehicles peaked in 2017. So they're way down off their peak. And there's Corona, the COVID period obviously put a big dent in vehicle sales. EVs are recovering very fast from that, and internal combustion engine vehicles are not as much. And it looks like we're past, from a sales point of view, peak internal combustion engine. It looks like that happened in 2017, and we never really get back to that peak. So around then there was somewhere around 85 million passenger vehicles sold. We're now way below that, and it's slowly coming back out of the COVID period, but all of the growth that's coming back and is on the plug-in side and not on the internal combustion engine side. So those are declining from sales. When you get to fleet, the fleet is still growing, because even sales today, cars stay on the road a long time, especially how well they're built now. The fleet of internal combustion engine vehicle sales is growing, but not for much longer. We think it starts to peak around next year or the year after, plateau for a little bit, and then start to come down. And that's when you really start to get the peak in gasoline demand. So we're in this year's outlook, we have global road transport gasoline demand peaking in 2026, diesel in 2027. Diesel's a bit later just because you've got a higher portion of that going into the commercial vehicle fleet, which is on a slower trajectory. And it's worth noting that that peak is not just driven by EVs. In fact, in the near term, a lot of it is driven by improvements in efficiency of the internal combustion engine vehicles that are being sold. And that's being done by things like the Chinese CAFC fuel economy regulations, Europe's vehicle CO2 regulations, and US CAFE targets, which of course leaves automakers free to choose how they want to get their efficiency gains. But EVs really do start to then play a bigger and bigger role in cutting into that demand around the from the late 2020s onward. And in both of our scenarios that we run in this outlook, and one of the scenarios is our economic transition scenario, which is when you do long-term outlook exercises, people don't like the word base case because it implies something about this is what we think is going to happen or that sort of thing. But what this is no new policies, essentially. It says whatever policies are in place today stay till the end of their life, but then we don't assume there's any new policies. That's the main one. And that's where we see this peak in around 2026 from overall road, or 2027 from overall road transport fuel demand. It doesn't go down to zero by 2050. In fact, it doesn't get anywhere near that in the net zero scenario. It goes down to around 20 million barrels per day, up from just over 40 today of road transport demand. But the way in the scenario where it goes all the way down, that's the net zero scenario, which we are not on. We're not on a trajectory for that right now. But one of the things we highlight in the report is that if you want to see it go faster, and often our policymaker clients are saying, how do you bend the curve down faster on emissions, and therefore, in this case, on gasoline and diesel use, the big thing we highlight is to say, you need action on commercial vehicles, because the passenger vehicle segment is actually on a reasonable trajectory. You're going to get pretty close, in our view, towards phasing out sales of combustion vehicles by around 2035 to 2040. Not fully, but substantially there, sort of 80% in regions like Europe and countries like China. The U.S. a little bit further behind that. Our headline number for 2040 is around 75% of or 72% of all passenger vehicle sales being fully electric. Now, again, that's assuming no new policies. Already this week, that might change. You might have a new policy in the U.S. that pushes that faster in that market.
Colin, let me be devil's advocate a little bit here. I think you would probably get reasonable agreement from many of the oil majors and say this scenario makes a lot of sense, especially when you're thinking about the sort of broad developed countries, the West. I think a lot of them see the real growth coming from India, Africa, and how do you see the development occurring in these rapidly developing economies globally? Are they going to just take a completely different path than we took here in the West?
Yeah, and I mean, this is a good point, and one of the things we highlight actually is that there is this big adoption gap forming between Western countries on EVs, between Western countries, or let's say wealthy countries, and emerging economies, and how politically palatable that is going to be in the long term, with especially with a lot of the resource extraction for these battery materials happening in emerging economies. You're going to see a big divergence in urban air quality in around 2030 between wealthy cities and emerging economies, even more than you already have because of this electrification. But one of the things that you find right now when you dig into the data is that electrification is not just happening from the top down. So if you go back 6 or 7 years, you think, wow, this all starts with premium vehicles and it's all starting at the top and working its way down. And then you would say, yeah, that isn't going to be what happens in big emerging economies. But if you look at the data right now, the best-selling EV in China right now costs around $6,000. It's got a 10 kilowatt-hour battery, about 150 kilometers of range. Real world to be more like 100, but it's an urban vehicle for a large emerging segment of the market. And you're starting to see the Chinese automakers really push into Southeast Asia, trying to set up in India. And you're also seeing a huge takeoff of 2- and 3-wheeler electric vehicles, which are actually the most successful electric vehicles to date. So China's electric 2-wheeler program, really driven by city regulations that just said you're not allowed to have internal combustion engine 2-wheelers in quite a few big Chinese cities. That has been the biggest part of that so far, but you're actually starting to see that in other places as well. So the 2- and 3-wheeler market in big emerging economies like India, in Vietnam, in parts of Southeast Asia, that's really picking up. So what I would say is that it's going to look very different in each market. It's not going to start with Teslas and work its way down, but you are going to get electrification from both the very bottom and from the top. And actually, it's the hardest segment will probably be the one that's kind of right in the middle of those two. So the bottom end goes, the top end goes, and then what you're left with is the hardest to address segment might well be things like the Honda Civic and Toyota Corolla, sort of low $20,000 new vehicles that last a long time, that are really durable, and it's still hard right now anyway to make a long-range EV that's fully cost competitive in that segment without subsidies. And of course, emerging economies can't afford large amounts of subsidies. So mobility looks different in each country. It looks very different between wealthy and emerging economies, and the road to electrification will look very different between wealthy and emerging economies. But it will still happen in our view.
Very interesting, Colin. So hang on for a second. We'll come back to you. Will Hares, I want to come to you next. Will covers the European oil majors. I think this is a very provocative outlook that Colin has just walked us through. How do you think they would respond to it? And are they optimizing their long-term strategies with this kind of vision in mind, in your view?
Yeah, absolutely. We are seeing the strategies starting to adjust for an obvious and explosion in electric vehicle adoption, but particularly in the more developed markets. So, for instance, BP reported yesterday they're targeting about 100,000 charge points by the end of the decade, up from roughly I think they're at maybe 1,000 right now, maybe somewhere around there. But I actually had a question as well for Colin around this charging, because charging is really the the center point of the exposure from the EU majors, and it's the style and behavior of the charging that I'm most curious about, because from a purely anecdotal standpoint, on my street in South London, the electric vehicle spaces are constantly full outside people's homes, and there's been fights over them, and there's been and they're in high demand. And then there's a brand new Shell recharge station with ultra fast charging a few blocks away that every time I go past it, I see it empty or nearly empty. And so I'm curious as to how, Colin, you're thinking about the behavior of EV charging and the impact that has on your outlook.
Yeah, definitely. And this is something we spend a lot of time on. Actually, our clients, we have a charging infrastructure outlook and model that people can go and play with, where you change the assumptions around charging speeds or utilization rates, and it changes what gets built in which country. So you can go and play around with that. the reality is today, most of the charging is done at home, but that over time, that reduces, partially because of what you just mentioned. Not everyone has a place to charge at home, so you need more and more public charging infrastructure. What you see in the markets where the EV penetration rate has kind of crossed around 5 or 6% of the fleet, so for reference in the US, you're going to cross about 1.5% of the fleet right now. You're still a ways away from that, but in places, in parts of Europe or in some cities in China where you've crossed a threshold around 5 or 6% of the fleet, you start to get higher utilization of the public infrastructure, and even more so in China where more people are in high-rise apartments. So I'm actually sitting right now in Oslo in Norway, and the utilization of the public fast chargers is actually quite high. So if you talk to the chargers here, the charger operators here, and you talk to them in other places where the penetration rate is higher, one of the things they say is that actually on DC fast charging, they're getting pretty decent utilization rates, enough for them to make a rate of return on the asset and go and build more of them. And the model kind of works there. I think one of the open questions we start to have, well, there's two, I guess. One of them is that if you're an operator, a fast charging operator, you want as many utilizations as possible in a day to make the business case work, right? Our analysis says somewhere around 7 to 10 events per day. You need people to come in and plug in for half an hour around there. But you don't want so many that people show up and it's always blocked. It's always somebody else using it. So there's a real fine line there for the charging operators where they want utilization, but not so much that it makes the use case difficult. The place we're most curious to see what happens is around this kind of slower speed charging at grocery stores, at places where the car sits most of the time. You've seen some business models that work for that. So some workplace stuff where people will put in a few. You've seen a lot of grocery stores and things like that start to add them. I think that works well for the first 5, maybe the first 6 or 7 that you put there. But it's a bit less clear whether you're going to eventually have 20 there, and how does that get paid for, or what's the business model there. So it definitely changes over time, and it changes based on the building stock that you have. So more high-rise probably means more needs for fast chargers, more detached homes, a lot more of the kilowatt hours, and therefore miles delivered or kilometers delivered are going to happen at home and in the garage.
Patricio, I want to get your reaction on this idea as well. What's your sense on the electric utilities? Are they excited about this opportunity, or are they worried that other players are going to come in and make all the money on the charging side of the equation?
I think broadly speaking, I think power utilities welcome increased electricity demand, and I think the advent of charging stations is part of that. We'll definitely contribute to that, and we'll definitely be favored by integrated utilities who already have network assets and transmission and distribution networks already. So I think it plays well into their business model. They already have the generation supply as well, which is part of an integrated utility business model. So they would definitely be a contender in that space. Although I know some of Will's oil majors have already ventured into that space, but I think the pie will be big enough. I think there's still a lot to be built, and especially for the retail side of utilities, I think it's going to be interesting because they're always finding ways of sort of expanding the business services and sort of boosting that consumption of electricity. So definitely something of a tailwind for them.
Okay, tailwind for utilities. Salih, I want to come to you. Salih Yilmaz covers Aramco and some of the names in the Gulf. What does the Saudi Aramco think about the rise of EVs? Do they see it disrupting their business model in any meaningful way over the next 30 years? Or are they also starting to think about this kind of energy transition type stuff affecting oil demand and their basic operations?
It's not something they mention often, so I think they must be aware of the risk that this has for oil demand, but they see this as a long-term risk and perhaps something that they're not too worried about right now, because they also keep reminding us that for oil demand, I mean, sure, we may be structurally losing some from EV adoption from fuel efficiencies, etc. But then there is the growth part for oil demand that's coming from petrochemicals. And in terms of the energy transition strategy, it's similar in some ways to the European oil majors that Will and I cover, but different as well. I mean, we haven't really seen them make any investment into anything related to EVs or EV charging stations, but they have acquired SABIC, which is the Saudi Arabia chemicals giant. So the direction they seem to want to take is just to expand further into the downstream value chain and just be bigger in that market that they tell us is going to be a growing market for oil demand. And at the same time, we know they want to have a bigger business in hydrogen. We know they have some blue hydrogen plans on the Gulf side where they already have some carbon capture and storage assets. And in the future, we know they have this very ambitious mega project of NEOM where they have plans to have some electrolyzers and produce green hydrogen on the Red Sea, on the northwest side in the country. So we are seeing them ramp up their energy transition discussion and kind of start some investments into energy transition, but EVs isn't quite something that we hear from them as much as some of the other European majors.
Okay, very interesting. Colin, I want to come back to you on the idea that we're in this really elevated commodity price environment. And what kind of feedback loop do you think higher retail fuel prices is having on demand for electric vehicles? And is it somewhat being offset by higher battery cost and other things? Or like how do you see the economics sort of unfolding this year, next year for EVs versus ICE?
This is a big live topic in our group right now, as you can imagine. So, so you have two different things pushing in very different directions, right? Battery material prices are way up over they were last year, and we're actually expecting lithium-ion battery prices to rise for the first time this year after falling dramatically, 90% or 88% over the last decade. So that's going to be a big moment. We're starting our price survey that we do annually now, and so it looks like prices are going to rise for the first time. Now, of course, everything's going up. So we have often said that to get real mass market adoption on the passenger EV side, it's less about total cost of ownership, so including the fueling cost and depreciation, and more about the upfront sticker price. So the upfront sticker price for EVs is going up, but the total cost of ownership of the alternatives, which includes fuel for an internal combustion engine vehicle, is going up really quickly as well. And this is where it gets a bit tricky because it depends a bit on what you believe, whether people really care about total cost of ownership or whether they really care about sticker price. And especially when you see these really big headlines on gasoline prices, that does look like it's driving consumer interest in electric vehicles. The biggest issue, though, is that when they go out and try and buy them, there's a wait list for most of them because most of them are kind of supply constrained right now, partially because of this metals issue. So I think overall, this commodity sort of boost that you see right now, boom in prices, is driving more EV adoption and is pushing that further. And those high prices that you're seeing on the battery metal side are also driving more exploration and more expansion of output. So you see already things like cobalt prices. Those have come down about 35%, or almost 40% from their peak now in May. And that's really because of two things. One of them, it's because more supply came online, mostly from the DRC, from one of the mines there, because of high prices, and also more substitution. So high cobalt prices pushed more and more automakers to use alternative technology, battery technologies that don't use cobalt. So lithium iron phosphate batteries are the one of choice in China. More Western automakers picking that up to avoid that cobalt, both for ethical reasons and for high price reasons. And those two effects are the same things that happen with any high commodity price, right? So you get substitution and you get new supply coming online. So it looks like to me like a lot of the battery metals things are going to be an issue for a while, but they're also going to behave in some of the same ways that you've seen other commodities behave in over the last 100 years, which is that high prices are still the cure for high prices. So I think this will be more of a, I think overall, it doesn't change the trend. It pushes it both in a bit of different directions, but I do think from a consumer point of view, it's driving significantly more interest on the EV side.
Colin, you mentioned policy a little bit earlier, and right now we're waiting to see whether the U.S. is going to pass this so-called Inflation Reduction Act, which is basically a slimmed-down version of what was previously called Build Back Better. I know you put out a piece just the other day looking at what that could mean for the EV picture in the United States. Why don't you give us a sense of how important or not this potential legislation would be for electric vehicles in the U.S.?
Yeah, it's a big moment. So the U.S. is very far behind China and very far behind Europe on electric vehicle adoption, and also on building out the supply chain to supply those vehicles. So battery processing and battery production and EV plants, they're all significantly behind Europe. So this bill could potentially put the U.S. kind of back in the race, if you will, but it's complicated. So they're adding all these tax credits that in theory, all the automakers would be eligible for again, with some specific income caps from the buyers and some eligibility caps on the price of the vehicles that mean not the wealthiest people and the most expensive EVs aren't eligible. But the big thing that's really hard to unpick right now is around these raw material and battery requirements that they're putting in place. So they're basically saying more and more of the supply chain has to be localized, either in the U.S. or in a country that the U.S. has a free trade agreement with. So the question is, how quickly can that actually happen? Can you sort of re-onshore a lot of that battery, particularly the battery material processing part? And the automakers right now are starting to say, actually, we can't do that. We can't meet those requirements very quickly, so we're not going to be able to get access to that tax credit. I think, but that's not the only thing that's in the bill. So there's the tax credits, which should be a boost in the long term. But there's still the short-term part about how quickly you can re-onshore the supply chain. But then there's other provisions in there on loans for converting EV facilities, which is going to be big, on commercial EVs, significant amounts of money there to try and get the commercial EV market started. And a number of other areas like that I think all the attention gets paid to the tax credits, but those other areas are going to matter a lot too. So I think it's a big moment for the U.S. I think we could be next week sort of rewriting the curve that we're expecting on adoption, but there's still some things to work out.
Okay, very interesting. I see we're running out of time. These conversations always go so quickly. I want to do a quick round the room here and just get some quick reaction from Will, Salih, and Patricio. Will, I think policy is in play. We've got the rise of EVs. What's the next 12, 24 months look like for the companies you cover, and how much of this is in the next 2 years or more out in the next 10 years?
So the next 12 to 24 months for my coverage, which is the European oil majors, is probably going to include a lot more of what we've just seen in the first half of the year. This is very large, substantial operating cash generation, free cash generation, debt reduction, and this excess cash being deployed into two main areas. Number one, shareholder distribution. So we're seeing big buyback programs come through and gradual dividend increases, trying to recover to these pre-COVID levels. And number two is energy transition M&A. This group has been relatively active. We're seeing a higher and higher share of CapEx being deployed into this area. We expect roughly 20% of total CapEx to be into green or energy transition businesses. And of course, EVs is going to continue to be a big part of that, expecting a 5 to 10-fold increase in charging points as these energy transition strategies really lean on integrating across the the power chain for these companies. So with them owning the production, the distribution, and the retailing, and able to leverage some of the big trading capabilities that they have to try and bolster returns in what has been a historically lower margin business compared to traditional oil and gas projects.
Okay, similar question, Salih. Energy transition and the companies you cover, what's the next 2 years going to look like?
Yeah, I mean, not much to add to what Will said. I mean, I think it's going to be a very similar picture for some of the smaller, mid-sized integrated that I cover here in Europe. But what I'd like to point out is that I think for the last couple of years since the pandemic, we really worried about demand a lot, kind of the short-term demand outlook. That very quickly changed into essentially a supply panic. So we worry a lot less about demand because it's been very resilient and it's been coming back up very strongly. And currently, at least in the oil market, what we're worried about a lot more is whether we have enough supply. And in the next 12 to 24 months, I think this will continue to be the case, which underlines why our outlook for benchmark oil prices are very constructive. And with that in mind, similar to what Will said, I think we will see these companies that we cover do pretty well, further improve their balance sheets, and really have a lot more room for, I mean, the buybacks that they've been doing, perhaps room for a little bit more dividends, but also more M&A, which undoubtedly, as Will mentioned, will include more energy transition deal making as well.
Okay, and Patricio, same question for you. Are your companies completely distracted by the European gas crisis, or when they're talking about current earnings cycle, is any of the energy transition stuff playing front and center?
Absolutely. So on both fronts, European utilities are still at the forefront of leading the energy transition here in Europe. So that's still a main key driver of the earnings. But in terms of what the energy crisis means for them is the earnings outlook for the group is mixed for the next 12 months. And that's mainly because of the power price and gas price volatility that doesn't seem to subside. And the way to see it is that the utilities are sort of a pass-through of cost inflation. So you see wholesale prices go up, but they don't flow through customer tariffs immediately. So we still see we still see a good outlook for them in the longer term as we see nations such as Germany, now the US with this new draft bill. There's sort of many nations are accelerating their energy transition targets and renewable deployment targets, and we see European utilities as very well placed to capture that growth beyond this I'd say near-term volatility that we're seeing in prices. And obviously integrated utilities with a geographically diversified footprint have a better chance of weathering this near-term volatility in a better way. And we see obviously companies with exposure to Russian gas supplies particularly exposed to disruptions, as any shortfall in supplies would mean that they have to go and buy back power or gas in the wholesale. They won't be able to pass on those costs in the near term. So mix beyond the turbulence.
Okay, thank you, Patricio. Colin, I want to come to you for the last word. What % of vehicles sold this year are going to be plug-ins, and what's going to surprise us most in the next 12 to 24 months in your space, do you think?
You mean globally or in a specific market?
Globally.
I think we've gone this year. We're heading for around 12% of all vehicle sales in the world are plug-ins. I actually need to check that. It's give or take a % there. I think the thing that's going to surprise us is that who buys an EV is going to be a very different thing. So people have a certain image of who the EV buyer or driver is, and one of the things you're going to see is that there's a huge number of new models launching that are in the pickup truck segment or their SUV segment, and it's going to challenge a number of people's stereotypes about who is an EV driver. And I think that's going to be the moment it sort of clicks for a lot of people that that's the direction the auto industry is taking. There are still challenges. There's still a lot to do. There's a lot of work ahead, but there's nothing I've seen that makes me doubt that that's the trajectory that we're on.
Okay, we'll have to leave it there. for anyone who wants to learn more about these topics, so I want to give you two adverts real quickly. One is tomorrow. We've got a webinar specifically to go really deep on the Inflation Reduction Act. So myself, Brandon Barnes, Nathan Dean, Andrew Silverman, and Dwayne Wright will be having a discussion in detail on how to unpack that and think about it. That's at 11 a.m. New York time, 4 p.m. London. And also tomorrow, if you want to go deeper on the oil market, Salih Yilmaz is doing a webinar that looks at the broad range of price outlooks. Could go as low as $65 per barrel, some say. Some are even saying $380 a barrel. So join that webinar if you want to know more about the commodity price. That's at 3:30 London, 10:30 New York. As always, feel free to shoot us an IB, ask us a question. Colin, Patricio, Salih, Will, we're all available on Terminal, so we're easily found and we're happy to help. So thanks for your time, and we look forward to being in touch with you. Take care, everyone.